Hello, everyone. Welcome to my live session. As we wait to see if anyone is going to join us today, I'm going to go ahead and wait a little while before getting started. But I will let you know what we're going to discuss today. So, the topic we're going to go over today is assets. So, we will discuss assets, we will discuss the different types of assets and give examples. We will go over depreciable assets versus non-depreciable assets. We will go over the fair market value and a book value. We will tell you what the difference is between the fair market value and the book value and why it's important. And we will also go over some tips on how to track your assets, the best practices. So that is what we will be reviewing today. Few more seconds. If as you're joining, if you are joining the live, go ahead and let me know that you're here. Let me know you're with us. I'm gonna go ahead and get started now. I can't wait too long. So let's talk about assets, right? Okay, so first of all, what are assets? So assets are resources owned by the business with economic value. So that means that you have some type of I'll go over the different types of assets, but it has a value. Assets have a value. So some examples of assets are office equipment, vehicles, um, laptops. Laptops and computers are assets. Your furniture, building, even like software and licenses are also assets. So if you have a copyright or something to that extent, that is also an asset that a lot of companies don't even think about being an asset. But you have to think about it. If you're going to sell your company, that's something you will present to the investor or to the individual that is interested in buying your company. Another one is cash. Cash is an asset and also accounts receivable if you provided a service, but we're going to go over accounts receivable later on. But accounts receivable is also another type of asset. So those are some of the different types of assets. And as we are going through this, if you have any questions, just jot your questions in the chat and I will address the questions as they come in. And also, let's just to let you know a little bit about myself. I am Shavis. I'm a financial strategist. I work with home care agency owners. I help them increase revenue by 25% or more with organized accounting and financial strategies. I also work with other business owners as well. So that's just a little bit about myself. Moving on, let's go ahead and go over the different types of assets. Now, your assets, they are listed on your balance sheet. If you've been following me, you notice that one of the financial statements I focus on is the balance sheet. And that's because the balance sheet is like where the health is, it lets you know how healthy your company, your business really is. Um, and so assets is a part of the balance sheet. It's one of the first things that you will see on your balance sheet is your assets. It's also part of the accounting equations. Assets minus liability equals owner's equity, right? So this just lets you know how important assets are to your business. Um, so when you look at your balance sheet, you will see that your assets, they are listed based on liquidity. That is how quickly and easily they can be converted into cash. So they are divided on your balance sheets into two different categories. They're divided into the current assets and non-current assets. So the difference is that your current assets, they are expected to be used and converted to cash within 12 months. So if they're not converted or you don't think they can be converted into cash within 12 months, then that's when they go into your non-current assets category. So some examples of your current assets are your cash. Cash is your bank balances. This is your checking account, and your savings account. Your accounts receivable is also a current asset because you provided a service and you expect to be paid for your service within, you know, you're expected to get paid for your service within a day or two. Me, I expect to get paid within a day or two of my service. But when we're talking about home care agencies, because you deal with Medicaid or insurance companies a lot, it does take a while for those insurance companies to reimburse you for your services. And then if the insurance company does not reimburse you for 100% of the cost of your service, then you will have to invoice the client. So this is your accounts receivable. If you provide the service, but yet you are waiting to receive payment for that service, then that is what's going to fall under your accounts receivable. Now, I'm taking some time with accounts receivable because this is very important, especially for cash management. You want to monitor your accounts receivable on a regular basis. And the reason is so you will know who hasn't paid you for your service. Um, it's important to get your funds. And then if you don't receive the funds for your service, then later on you may have to go in and make some adjustments to allocate that cost or that expense, that amount to your expenses as bad debt. Because eventually, if you don't receive payment for it, you probably have to go ahead and put it in as bad debt. But yes, so that is one account within your current assets that you should monitor on a regular basis. Um, I like to look at it as that it's the I'm waiting to get paid list. So yes, that is your, and then also another current asset is your supplies and inventory. So if you have supplies or you have inventory, um, if you pay for your inventory, that cost that you pay for your inventory does not go into your expenses. It is your inventory cost. It is a spreadsheet or it is a process or a method that you go through to account for your expenses, account for what you sold, your beginning balance, your ending balance. It's a method to your inventory, but your supplies and inventory is also listed on your balance sheet. And then we have our non-current assets, which is our fixed and long-term assets. Do we have any questions? If y'all have any questions while I am going over this, please feel free to go ahead and ask. So now we're going to go into our current non-current assets, which are our fixed and long-term assets. So the non-current assets, which you'll see typically under this category are um, your depreciable assets, your equipment, your furniture, vehicles, buildings, even leasehold improvements. So if you have a group home or if you have an assisted living facility um, that you're leasing, um, and you've made improvements on this, like for instance, you may have to go and do some work in the restrooms, in the bathrooms, because a lot of times for the tubs you need to have those rails there, or even in the front you may have to add a ramp to the home, if it's a group home or assisted living facility. There may be some upgrades that you have to do or some construction work that you have to do so it could pass regulations so you can receive your license. So this is what you will also include in your leasehold improvements. Now let's go ahead and go to our depreciable assets. Let's go and let's discuss what depreciable assets are and like some components that are included in the depreciable assets. So first of all, let's get an understanding of what are depreciable assets, right? What is depreciation? So depreciation reflects how the asset loses value over time. So your asset does not increase in value, your asset actually decreases in value over time. And some examples are so when you have depreciable assets, you'll have a depreciation schedule that goes with it. Now sometimes the rule of thumb, like when you're gonna, because you can purchase an asset that is not depreciable, right? So the rule of thumb is that if the asset has a useful life for over a year, which is one, and then the second is that it's up to you as a company to determine how much you would spend on the asset before you want to put it on your depreciation schedule. So, but the rule of thumb is that if your asset is over $2,500, then you will go ahead and depreciate it. If it's under 2,500, then normally you can go ahead and expense it if you would like. But it all depends on how you want it to show up on your expense report. With that being said, I did do a video recently and it's on my page. I went over depreciable assets. I went over how to actually create a depreciation schedule. I even went into QuickBooks and we went over the different components of the depreciation schedule in QuickBooks because QuickBooks they have it's just for the advanced subscription of QuickBooks, but it is really neat. They have a really good asset schedule there that you can put your assets in, and it will generate the depreciation schedule. But you can also use a spreadsheet to generate a depreciation schedule as well. So so I do have an example that I can share with you. And that is, so let's say you purchased a van for your agency, and you purchased that van for 30,000, right? $30,000. So a van is like its useful life is 5 years. So we're going to depreciate this $30,000 van for 5 years. So instead of expensing this van for 30,000, which you should not do, even though with taxes they are allowing us to do the bonus depreciation, but that's going into tax strategies. Um, you would typically look at some things before you determine if you want to depreciate your asset. Or I hope your tax professional is looking into your return as a whole to determine if you should use 100% of uh, the cost that you pay for your asset. But that's not what we're discussing here. Let me get back on track. We have a van. You purchased a van for 30,000 for your agency. So this van will depreciate for 5 years. Now, I'm gonna go into some terms with you because you can do a salvage, you can't say like, okay, after 5 years, this van is still gonna be worth something. I can still sell this van for a price or yes, I can still sell this van and receive some funds for it. And so a lot of times you can put a salvage value to your asset. So I know for buildings, typically, especially if we're doing Medicaid cost reports, you have to put a 10% salvage value for your building. So here for this vehicle, you can also use the 10% salvage value until it is disposed or sold. And this salvage value will remain on your balance sheet. So we could take 10% of the 30,000 as a salvage value, but what we're going to do, we're just going to leave it as is just to make our math simple. And so what we're going to do is depreciate this vehicle for 5 years. And so if we depreciate this vehicle over 5 years, that's 6,000 per year that we will be expensing the vehicle. So instead of taking the full 30,000 to your expense report and having your depreciation be 30,000, we're going to just do a little at a time. So every year on your expense report, you will have a depreciation expense of 6,000. And this will also lower your balance your asset cost on the balance sheet. So I hope I explained that. So some of the terms that we can use when we're dealing with or talking about depreciation schedule, some of the things that we need to know is the purchase date, the useful life for that asset, salvage value if we decide to go ahead and um, calculate for the salvage value, the depreciation amount. Um, I think I mentioned everything. So it's the depreciable, the purchase date, the useful life, the salvage value, and the amount that is being depreciated. So those are some of the things that you would need. And I do have some of the common assets that you will see for home care agencies are, I'm gonna just throw out some here. And I want to just go over the useful life of some of the most common assets. So if you have office furniture has a useful life of 7 years. Your computer, if you want to depreciate your computer has a useful life of 5 years. And the reason I say that because computers, I don't know what kind of computer you may purchase, but computers, I don't really see computers that's over 2,500. Now, it may be, if it is, let me know because I may be overlooking something, but I normally don't see computers that's over 2,500. So, um, the company vehicle. A vehicle is 5 years, has a useful life of 5 years. Building improvements. Building improvements has a useful life of 15 years. So these are just some of your most common assets that you will see. And I'm just throwing out some of this so you get an idea of how long these assets are expected to last. So now let's move on. Do we have any questions over the depreciation schedule? I don't see any. Now let's go ahead and move to the fair market value versus your book value. Okay, so assets can have a fair market value that is different from the book value. Now, the reason for this is that the fair market value is what the asset will sell for in an open market. The book value is the original cost minus the depreciation. So even if your asset, and this is what I was mentioning about the salvage value as well. So, or even if you don't calculate the salvage value and your asset is fully depreciated on your books, it still may sell in the open market. You may still be able to receive some funds for this asset in the open market. So sometimes it's good to keep a separate log of your assets outside of your normal financial records. A lot I see this with trucking companies and even I was gonna say for my for homes, um, like if you do short-term rentals or if you have rental property, I would say that you do see this sometimes, but normally when you're selling those assets, they haven't been fully depreciated yet. So for assets that have been fully depreciated, like for instance, um, and even if it hasn't been fully depreciated and you know that you can receive more, for that asset in the open market than what's shown on your books, then it's good to have that separate log outside of your books. And that's because on your books, your asset is being depreciated for now. They do have some different types of depreciation methods. But on your books, normally, typically, what you'll see your accounting use is a straight line depreciation. So, um, your book value may be different from the fair market value. So it's good to have a separate log for your assets and even your assets that you expense, because those assets are not going to show on your balance sheet. For instance, as I mentioned with the computers, a lot of times the computer, yes, they're going to have a useful life for over a year, but the value of it is not worth putting on your balance sheet and depreciating it over how many years? Over 5 years. It's not worth it. So you will go ahead and expense that full amount on your expense report. And so when you do expense that on your expense report, um, it's good to have a separate log as well, because your expense report will uh, close out at the end of every year. And so it won't show on your expense report next year. So that's why it's good to have a separate log as well. Just if you do decide to sell that computer, if you decide to sell your company and your computers are included in your company, then that's an asset that you want to show your potential buyer or even your investors. If you have someone that's willing to invest in your company, this is something that you can show your investors, like, and show them that your what your company is really worth. It will help you to explain what your company is worth. So that is I think I discussed everything for fair market value versus the book value. If I missed anything, just let me know. And now let's get down to tracking and managing your assets. As I mentioned, you can use software to help track and manage your assets. As I mentioned, QuickBooks has a really good one. It's with the advanced subscription. Um, it's good. You can go to my video and take a look at it, because I broke down everything for how to track. You can also, as I mentioned, do a separate log, which I recommend having a separate log for all of your assets, those that are being depreciated and those that are being expensed. Um, and you can also use a spreadsheet. That's what I wanted to mention as well, is that as long as your spreadsheet includes all of the components, and that is the asset itself, the purchase date, the useful life, and then your depreciable amounts, and even a salvage value if you decide to go and calculate for the salvage value. If you want to keep up with your assets on a spreadsheet, then go ahead. That's a good way to keep up and manage and track your assets. So, I hope this information was helpful. I do have I have a cheat sheet that shows the useful life. I'm gonna go ahead and put that in the description area. If you want to go ahead and grab it, feel free to go ahead and grab it and use it, just as a reference. So today we were able to cover, all things pretty much asset related. So we went over our current assets, our non-current assets, depreciable assets. We went over the fair market value versus the book value, and even some tips on how to track your assets. So I hope this information was helpful. If you have any questions for me, feel free to ask. I do have a community. If you are not ready to to invest in an accountant and to manage your books, and you want to be hands-on and manage your books on your own, I do have a community, a support community, to where you can manage your books, but I will help you along the way if you need that guidance. That information will also be included in the description. And as always, um, like, subscribe. I don't normally do that. But yeah, subscribe to my channel, like my page, all of those necessary things. I really appreciate it. And when I go live again, you'll end up receiving the notifications and everything you need. Um, and as always, wishing you much success in your business. Thank you for watching. Bye.